You have probably noticed your grocery bills getting heavier. You buy the exact same milk, the exact same bread, but the total keeps climbing. Then you check your bank statement and see your online software subscriptions, your streaming services, and your digital storage are all quietly pulling a few extra dollars every single month. Nothing obvious changed in your routine, but the currency your country uses to price all of those goods is constantly moving in value in the background. Every time that value dips, it actively shrinks how many physical goods and digital services your regular paycheck can actually secure in the real economy. It operates as an invisible, shifting tax on everything you buy. Even if you never look at global exchange rates, the math is happening directly inside your wallet. A few years back, I was looking at a camera from a European seller. I waited a couple of months to pull the trigger, and when I went back to make the purchase, it suddenly cost significantly more in dollars. The manufacturer had not upgraded the lens, they had not changed the sensor, the dollar had simply slipped in value while I was not paying attention. It is easy to assume someone in a government office is turning a dial in a closed-door room to set that daily value. But for major currencies, nobody is manually setting a price. The value comes down entirely to global supply and demand. That demand is driven by a simple question. How much does the rest of the world want to hold, use, or invest in those specific dollars right now? If you ignore those international demand shifts, you end up caught completely off guard when the cost of your everyday purchases suddenly spikes. This chart shows the direct relationship between currency strength and everyday costs. When the US dollar indicator goes up, imported foreign goods become cheaper. Taking a vacation overseas also takes less out of your savings. Watch what happens when the dollar weakens. As the dollar indicator falls, the exact same imported electronics, clothing, and car parts immediately get pricier for domestic consumers. But there is a counterintuitive advantage hidden in that drop. We can add an export volume indicator here. As the dollar weakens, American products become cheaper for foreign buyers, driving up demand and revenue for domestic businesses that sell abroad. This translation takes a headline that usually feels like abstract noise and gives you a way to filter it for its potential impact on your own spending. It turns currency strength into a practical data point for timing an imported purchase or understanding why demand might be shifting in an industry that sells American products overseas. If you earn your income in dollars, pay your rent in dollars, and keep your savings in dollars, your entire financial environment is governed by these global movements. The baseline rule is straightforward. When the world wants dollars, your money goes further. When they do not, your purchasing power drops. There are exactly 5 macroeconomic forces actively pushing that global demand up or down at any given moment. US dollar at the center. First, interest rates, the cost to borrow or reward to save. Second, inflation, the rate prices rise. Third, trade balances, the import and export gap. Fourth, investor confidence, measuring capital safety. Fifth, government debt and money supply, total cash circulating. Over the rest of this video, we will break down exactly how these 5 forces interact in plain English. We will look at the mistakes people make when they ignore them and lay out a step-by-step financial plan. Understanding these mechanics transforms the dollar from an abstract number into a factor you can actually account for when making smarter money decisions. An exchange rate is simply the price of one country's money measured against another. When buyers in one country purchase items from another, they must exchange their money. If international buyers want more of what a country produces, demand for its currency rises, pushing the value up. Conversely, if appetite dries up, the currency weakens. A currency's value is never a static number. It is a live reflection of how much the world desires what that nation makes. In the real economy, this global demand is driven by 5 specific macroeconomic forces. Macroeconomic forces are broad factors that affect a whole country's economy, like growth, employment, and monetary policy. The first of these forces is interest rates. This animated diagram shows domestic interest rates acting as a magnet. When a central bank raises rates, offering higher returns, it draws foreign capital directly inside its borders. When rates drop, that same capital quickly flows back out to seek better returns elsewhere. The second pillar is inflation. Inflation is the speed at which the prices of everyday goods and services increase over time. If domestic prices are climbing rapidly, each unit of that currency buys less and less. Investors notice this loss of purchasing power and avoid holding cash in that country. To keep international investors confident, a country must maintain steady, predictable prices. The third pillar is the trade balance. When a nation exports a massive volume of goods abroad, foreign buyers constantly need to acquire its currency to pay for their shipments. This animated diagram shows the opposite scenario, a trade deficit. When a country buys far more imports than it sells in exports, the immense weight of outgoing payments creates persistent downward pressure on the currency's value. The fourth pillar is confidence in a country's baseline economy, its institutions, and the rule of law. The rule of law is the principle that all people and organizations are held accountable to the same set of fairly applied laws. Trust is highly volatile. If property rights look shaky or political stability fractures, investors will quickly pull their money out of the country. Modern fiat money is backed by nothing but faith. Fiat money is a national currency that is not pegged to the price of a physical commodity, such as gold or silver. An exchange rate weighs international trust in a nation's stability just as heavily as its tangible economic output. The fifth and final pillar is government debt, combined with the rate of new money creation. Looking at this animated bar chart, we see the core danger. If a government expands its money supply aggressively while actual economic production stays flat, it creates a massive gap between the number of bills in circulation and the actual goods available to buy. Printing new money without a matching increase in economic output does not generate wealth. It mathematically dilutes the purchasing power of every existing bill in circulation. There is no single official sitting in a room picking a fresh exchange rate each morning. This animated diagram demonstrates how open markets actually work. Major exchange rates are determined in real time as these five forces continuously push and pull against each other to find a state of equilibrium. Equilibrium is the point where market supply exactly balances market demand. You do not need to build a complex mathematical model to forecast the exact daily path of these moving forces. You only need to ask one practical question. Do these combined forces currently make this currency look more attractive to the rest of the world or less attractive? When analysts ignore that basic question of global attractiveness, they misjudge the market. Here are the specific mistakes people make when they lose sight of the pillars. Many Americans grow up with a specific financial blind spot, the belief that the United States dollar is a permanent, untouchable force of value. The dollar is one of the world's main reserve currencies. A reserve currency is a globally recognized money held in large quantities by central banks and major financial institutions to settle international debts. But being a global standard does not mean its purchasing power stays perfectly static day to day. This chart shows the historical value of the dollar against a basket of other major currencies. Look at these multi-year valleys. The dollar has gone through long, measurable stretches of weakness, proving its value is far from a flat line. When the dollar dips into one of those valleys, it shrinks your purchasing power abroad. Mathematically, your money buys fewer hotel rooms, fewer meals, and fewer souvenirs when you travel. And back home, that same weakness applies directly to the prices of imported goods. A shrinking dollar means it costs a retailer more to bring a product across the ocean, a cost that is passed directly to the consumer at checkout. Treating a fluctuating asset like a fixed constant means you will eventually be caught entirely off guard by these shifting costs. When those costs do shift and the media runs headlines about a dropping dollar, the immediate reaction for a lot of people is pure fear. That fear triggers a knee-jerk rush to overhaul entire portfolios. People scramble to buy gold, foreign currencies, or complex alternative assets. The problem with reacting to these headlines is that day-to-day currency moves are incredibly noisy. A dramatic drop over 2 weeks provides almost no reliable data for multi-year financial planning. Making massive adjustments based on a few volatile weeks mathematically forces you into buying high and selling low. The emotional reaction costs far more money than the currency dip itself. That emotional reaction also leads to a severe analytical error, blaming the exchange rate every time a price tag goes up. This chart breaks down the actual mechanics behind consumer price increases. The currency exchange rate is just one thin slice. The final cost is dictated heavily by shipping logistics, supply chain bottlenecks, local taxes, and corporate profit margins. Using the dollar as a universal scapegoat means you miss the real reasons your expenses are climbing. Another massive error is assuming a single currency shift hits every single person the exact same way. A stronger dollar is excellent news if you are ordering custom furniture from Europe. It provides zero relief if you are struggling to pay your local electric and grocery bills. Conversely, a weaker dollar makes American-made goods cheaper for foreign buyers, directly boosting the revenue of domestic exporters. But for a business relying heavily on imported raw materials, that same weakness crushes profit margins. This leads to a persistent financial myth: the idea that a strong dollar guarantees a healthy, thriving domestic economy. During periods of global economic stress, foreign investors look for safety. They buy massive amounts of United States government bonds. Government bonds are essentially IOUs issued by the Treasury, widely considered one of the safest places to park capital during a crisis. This massive wave of foreign investment funnels into the US bond market, mechanically forcing the dollar higher on the global exchange. But notice the disconnect. The top-line dollar value stays elevated, while actual consumer purchasing power is dragged down by skyrocketing housing and medical insurance. The macro metrics look fantastic on paper, while entirely masking the financial strain felt by the average citizen. Whether it is blind faith in the dollar's strength or panic selling during a dip, all of these mistakes stem from operating at behavioral extremes. Ignoring the macroeconomic data entirely leaves you blind, while reacting to every terrifying news alert leaves you paralyzed. The smart approach lives precisely between those two extremes. It requires maintaining constant situational awareness of currency trends while stripping away the emotional weight of the daily news cycle. When you view exchange rates strictly as raw data, you stop making sudden, dramatic portfolio pivots. Instead, you make measured, strategic adjustments to your spending and investments over time. Replacing fear with objective understanding turns currency fluctuations into a reliable tool for long-term planning. Here is the step-by-step methodology to do exactly that. We know what drives the value of your money, and we know what mistakes to avoid. Now it is time to focus on the actionable habits you can use to protect your personal wealth every single day. Step 1 is building a simple routine. You need to check a broad measure of the United States dollar just once a month. This chart shows the dollar indexed. It is the perfect tool for this routine because it compares the dollar against a basket of several major world currencies. You are not looking at this to predict the future. You are just asking a simple question to get your bearings. Has the dollar mostly been moving up, down, or sideways? Establishing this basic situational awareness is the foundation. It gives you the necessary context to make all your subsequent spending and investing decisions. Step 2 comes into play before you make a large purchase that relies heavily on imported parts, like a new car or a major home appliance. Check the current currency trend first. This infographic shows how a broadly stronger US dollar works in your favor. It helps depress the retail price of those imported goods. But when we look at the reverse, a weaker dollar adds upward pressure. The exchange rate costs ultimately get passed down to you at the register. You do not need to time the market perfectly. You just want to know whether the macroeconomic wind is at your back or in your face before you hand over a large sum of money. By checking the currency weather before you spend, you avoid paying an invisible premium on the physical assets you use every day. Step 3 is adding international diversification to your investments. If your portfolio is entirely in United States assets, you are fully exposed to a single currency environment. This diagram shows how international index funds work. They spread financial exposure across a wide array of different countries and currencies. When the dollar weakens at home, those foreign holdings can often get a lift in value when converted back into dollar terms. This is a risk management strategy to keep from putting all your financial eggs in one basket, rather than a speculative bet against the dollar. If you are unsure of the exact allocations, treat this as a starting point to discuss with a qualified professional. Setting this up acts as a built-in shock absorber for your portfolio whenever domestic currency loses strength. For international travelers, step 4 is using credit cards with zero foreign transaction fees. Those extra surcharges act like a death by 1,000 cuts. When the screen gives you a choice, always opt to pay in the local currency. Choosing the instant dollar conversion option mathematically guarantees you a worse exchange rate. Step 5 is for future planning. If you know you have an upcoming expense in another currency, like school tuition, family support funds, or overseas services, build a financial buffer into your budget right now. Leaving room for exchange rate movements ensures you stay solvent if the currency shifts against you. If it happens to move in your favor, you end up with a bonus surplus. By controlling the mechanics of your physical transactions and proactively budgeting for variance, you neutralize the anxiety of foreign spending. Step 6 is paying attention to Federal Reserve rate announcements. You do not need a master's degree in monetary policy to grasp the macro environment. You just need to know the basic rule of these announcements. Higher interest rates generally support a stronger dollar, while lower rates reduce that support. Step 7 requires you to look at your own paycheck. You need to understand how these currency movements directly impact your specific job or industry. This visualization shows the divide. If your company exports goods overseas, a weaker dollar can boost demand. But if your business relies on imported raw materials, that same weaker dollar drives costs straight up. You are not trying to predict your next promotion or a round of layoffs. You are simply anticipating the directional forces nudging your sector, so you aren't caught off guard. Tracing that chain reaction from the Federal Reserve down to your supply chain turns sudden corporate shifts into navigable, foreseeable trends. You do not need to become an obsessive currency trader, checking exchange rates every morning. You simply must accept the reality that the value of your money is not fixed. Remember, because your personal wealth constantly moves with the macro tides of interest rates, inflation, trade balances, and institutional confidence, choosing to ignore these fluctuations leaves you entirely vulnerable. You will feel the financial effects of your purchasing power shrinking without ever understanding why. If this made exchange rates easier to understand, tap like. If you know someone dealing with another currency this year, send this video to them. Comment biggest driver below and subscribe because I post new videos every Tuesday, Thursday, and Sunday. True financial empowerment comes from an active awareness of the macro environment. It replaces panic with calm, informed planning. I will see you in the next one.